Hello, my name is Vern.
And I'm Sharon Kreider, and we're here in the Western CPE studios in Bozeman, Montana. And Vern, do you know that Western CPE is about to hit 1 million? It is counting down to 1 million CPE certificates. And one of the reasons is that we try to give you important updates. We are going to discuss first the Vice President Joe Biden's tax plan with a guest. We have a guest zooming in with us. And our discussions of Vice President Biden's plan and President Trump's tax plan is not meant to influence you on either one. To say, because we're not here about politics, we're here about tax policies. And you may have opinions on policies, but even further away from politics or policies, we're here so that you have the information when your question says, when your client says to you, brings you that quick question, if Vice President Biden is elected to president, what does it mean to me and my taxes? Or if President Trump is reelected, what does it mean to my taxes? That's what we're trying to answer, because we really don't know the politics of many of our clients, and I think we try to stay really neutral until we figure that out. So let's start with our guest. We have a guest, Mark Seid. Mark Seid has a large tax practice and has a long history of working for the IRS. I think a decade of working as a field agent with the IRS. And you know him from his work with Vern in Vern tax seminars cross country, and his work with Sharon Kreider and Karen Brosi in the Federal California tax series. And you may have been lucky enough to hear Mark last year at the resort in Hawaii when he updated the classroom on what we needed to know for our tax return preparation. So welcome, Mark. And Vern has the first question for you, an easy one.
So, Mark, what are Vice President Biden's key tax policies?
Well, we've got a long list of what's been proposed and gleaned from the information the Biden campaign's put out. For our individual clients, we're looking at some changes that'll probably impact our clients with income over $400,000. Seems to be the threshold they've selected. People under $400,000 not going to see a whole lot of change. One of the changes, top tax rate, dropped down to 37%, is looking at an increase back up to 39.6, but only on incomes over 400,000. We're looking at a couple of other changes. We're looking at Social Security, which currently caps out the 12.4%, caps out at about 138,000. There's a proposal in here to actually take that back in like Medicare on incomes over 400,000. So we're going to see a donut hole in the Social Security, which is between that 138,000 or as adjusted each year and up to 400,000. The 12.4% for the self-employed just disappears, but then it comes back again. It's very similar to the donut hole we've seen in Medicare in the past. We now have a 200,000 plus era of a donut hole. Also in the individual side, we're looking at capital gains will stay pretty much where they are until your income goes up again. So we're now looking at people looking at ordinary income rates on long-term capital gains, but only when their income's above $1 million. So we're seeing the increase on the tax rates, but as we get into the higher level of income for individuals. Also on the individual side, there's some significant pushes in credits. EITC will actually get expanded out to cover people that are over 65. And so for clients that you've had that have continued to work past what would have been a retirement in the past at age 65, nobody laugh here because I'm sure no one's over that age. those folks will now be eligible to collect social or collect EITC again. And that's actually a significant change because a lot of people, as they move towards retirement past 65, they don't have high earned income. And so that EITC that can come in could be a significant help for them. So EITC is going to pop back in for those over 65. There's an introduction of a new credit that is an interesting one I hadn't seen before, and it's for caregivers, for people that are taking care of folks at home. There's up to a $5,000 credit for caregivers, and I hadn't seen that one before, so that'll be something new. There is a rehash, if you will, of the first-time home buyer credit. If you've been in taxes for at least a decade or more, you know we had this back in the 2009 era, where there was a tax credit that came in. It was partly refundable, partly had to be repaid, and it bounced around a little bit. That was at a $10,000 threshold. This one is now $15,000. And the most important part about this one is you don't claim it on your taxes. You actually get it at the time you acquire your home. So this reasonably can be part of a down payment and pushes individuals towards home ownership a lot quicker than having to wait for their taxes, next April, and assuming they're buying in January, they could be 14, 15 months away from getting their $15,000. On the opposite side of that, something we haven't seen before is a renter's credit. Now, I'm in California frequently, and California has a renter's credit that's $60 for single folks and $120 for married, which doesn't do much. This credit is a credit that will cap the amount of total rent and utilities at 30% of the individual's income. Now, we don't have enough details on that, but that could be a truly significant credit for a lot of people. So those are, I'd say those are probably some of the key individual items. The other one that would be significant is an expansion on Affordable Care Act. Getting rid of the 400% threshold for being able to get insurance through the marketplace and get a subsidy, and changing from the silver plan up to the gold. And I've had lots of people tell me the silver plan's not quite going to cut it for us. We're going to need to go up to that gold. So this changes the level of the plan, and by indexing it to more than 400% of the federal poverty level, I think we'll see a lot more people get coverage over there. So that's a significant item.
And Mark, can I ask you about the child care proposal? Because those with little children have really been complaining about the cost of child care. And I believe that Vice President Biden has made some significant increases to that. But that sounded like a question maybe I shouldn't be asking right now. But I think he's increased it to $8,000 and $16,000. Does that sound right to you?
We're looking at 50% of the cost, up to $8,000 per child, maximum two for $16,000, refundable, and more importantly, for people that actually have child care, they're looking at a way of making an advance payment. So not only can they have that significant credit, it just, instead of reducing withholding, they can actually get some of the money now so they can pay their child care providers. So that's also a relatively significant change to the child and dependent care credit. A couple of other items he's pushing on the business side. I can tell you, as a tax preparer, one of our significant challenges over this last couple of years has been learning about QBI. And QBI is a formula. The proposal is to allow QBI, but to cap it off at incomes over $400,000. So our formula is going to get one more piece of math involved. That would be another significant change that we'd be looking at. On the corporate side, and these are just straight corporate with some business involved. Corporate rate went down with Tax Cuts and Jobs Act from 35 to 21, but it went to a 21% flat rate instead of the graduated rates we had before. And that was significant for our C corporation clients, of course, that had generally income under 50. They saw a tax increase. The larger income clients saw a tax decrease. Biden's plan takes it at a flat 28%. So it's kind of the midway between the 31 and the 35 and the 21. We're now looking at a flat 28. So for the folks that were in the lower income sections, that would be an increase. For the corporations that had higher income, of course, we're looking at an increase from tax cuts, but still a decrease from pre-TCJA. Bonus depreciation is on the table. No real specific things other than, trying to cut some of the corporate benefits. It's going to probably phase out on its current schedule under Biden. I'll let Karen talk about what Trump's plans for it are. The international issues are there, probably more than we can get into here, but GILTI is looking like a doubling from 10.5% to 21%. And there's all kinds of things tied to the corporate tax rate that would be impacted. If they change the corporate tax rate, the general rate, it's going to impact a couple other rates as well. So we're going to see some sweeping changes there just by making a single change in the tax code. I guess there's two other things I think are important, and those involve energy. Biden has said he's going to stop subsidies to the coal industry. We're going to get rid of that, and on the opposite side, pushing credits, tax credits on renewable energy, making permanent things like the work opportunity tax credit, and as a significant move in that one, adding another category, military spouses being involved in work opportunity tax credit. So we'll see a push towards an increase in that credit, which if you've been in taxes for a while, you've seen that credit has gone back and forth from being expiring and extended many times. This would make it permanent, which of course makes planning for the businesses a little bit easier. That would be a significant item on the credit side for employers.
It's expansive, isn't it, Mark? The policy changes are expansive, really lots of details in those tax policy changes. But let me ask you, now those are your list, your explanation are what Vice President Biden wants. They're listed out in his campaign, and his tax advisors and economic advisors have said these would be good changes. But for those to be accomplished, it seems to me that Vice President Biden would have to have a trifecta. He'd have to have Democrats in the House, Democrats in control of the Senate, and then he'd be in the White House. If that doesn't happen, if it's, there's so many variables here, but if that does not happen, then where would you think that Vice President Biden would find bipartisan support? Or is there any possibility that one or more of his recommended changes would be enacted through a split Congress as it is now?
Well, I think there's a couple of key provisions in here that'll gain bipartisan support. And most of those are going to be focused on continuing recovery of the economy from the pandemic. So things like the work opportunity tax credit, where they're targeting employers being able to hire employees and get benefit for it. Those type of things are going to be at the center of bipartisan support, making sure that people can work. And that was the focus really of the CARES Act that we saw this past year, was making sure people could get back to work, because both sides of the aisle want to see America fully employed, the businesses able to hire them and feel confident that they can pay for the salaries. So I think the focused items on making sure there's full employment are the items that'll gain full support. When it comes to party politics, things like increasing or decreasing tax rates, those are the things that I think are probably going to fail. They won't have that bipartisan support if they want to increase or decrease a tax rate, either in general or on a specific group.
I think, well, I agree with you that nothing's been happening in Congress except what was focused specifically on the pandemic. And we're hoping that we're not so maybe up to our chins in the pandemic next year. But I was thinking a little bit about the deficit. I think Congress has spent $3 trillion on pandemic aid. And you and I know a great deal about PPP loans and forgiveness and EIDL loans, and way too much about other parts that came from the CARES Act. But I was wondering, with the deficit so much larger, if there wouldn't be some bipartisan support for maybe increasing taxes in some areas just because we have $3 trillion more of deficit. I think, Vern, that might be a 20% increase in our deficit this year from at least one year to the next. So what are you thinking about that? Is the deficit might mean that even if there is a split Congress, that perhaps there'd be some bipartisan support for increasing taxes on, let's say, corporations?
I think it's a philosophy of how the tax inflow is going to come to the government. And in part of the philosophy is, if you look at an increase in rates, that would increase taxes, but that only increases a rate. It doesn't necessarily increase the base it's applied to. So if you look at dropping tax rates to increase the volume of, to increase the overall income, you may actually see more come into the Treasury. And so it becomes a philosophical difference between the parties as to whether or not lower rates will bring in more taxes or higher rates will bring in more taxes. And that's where we stall between the two parties in Congress, and things go along party lines. So what we'll see is going to be probably some arguments in Congress, some discussion of how to bring more revenue into the government and pay for this debt, because you're right, we just spent a whole lot of money and we're going to have to pay it back somehow.
And then do you think that Vice President Biden, if he is elected and if it is a trifecta and he can get everything through that he wants, do you think some of these changes would stall the economy or grow the economy? Can he really do what he wants? Do you know that you and I have discussed this, Mark, Vern and I have discussed it, that the proposals from Vice President Biden are a $4 trillion tax increase over 10 years, the largest tax increase since World War II. Now I'm just remembering what I read. Now, I wonder if you believe that Vice President Biden could actually do all of these, even if he had total control of, you never have total control of Congress, what a silly thing to say. But even if he assumed he had total control of Congress, can he really do this and not further hurt our economy?
I mean, if the economy is stalled, would it stall? What's your opinion?
Well, I think one of the plans that they're putting forward here is they will be generating additional dollars, and the investment that they're trying to do is saying we're putting this back into infrastructure. So we're going to be building on everything from roads to national internet type items. So what we'll see is the creation of jobs there, and as the jobs start to turn over, reasonably the employers are paying tax, the employees are paying tax, the employers are making money and paying tax on their income. So it becomes a circular argument where you say we're going to increase the tax, but we're doing that to create investment in infrastructure items, and those companies will be earning money on which they will pay tax. So it turns around over and over again, and that's the concept behind it. Is as the economy starts to get an influx of government funds and just private investment, as they start to work forward in building more infrastructure, tax base goes up. And so while it's a tax increase, in a lot of ways, they're looking at the same thing. We're going to have more taxable income to apply the rates to.
Well, thank you, Mark. I want to know some of these details in order to answer the client's question. And I know you've had the same question I have from clients. What does it mean if this person, sometimes the clients aren't as kind or politically correct. What does it mean if a candidate is elected? And so we're grateful that you've taken the time out of your busy practice to talk to us about Vice President Joe Biden's tax policy. So thank you, Mark. Thanks. Talk to you soon.